Hi, it's Matt Aarons, Chief Investment Officer with Inman Wealth Advisors. 2023 seems to be the year of transition. You've all been so patient as we transition from Integrity Advisory to Inman Wealth Advisors. And now we've got another doozy going from TD Ameritrade to Charles Schwab. So on the move from TD Ameritrade to Charles Schwab, one of the questions that we've received is, hey, are we picking to go from TD Ameritrade to Charles Schwab? Definitely not. If it was up to us, we would most definitely stay at TD Ameritrade. But if you recall, a couple of years ago, Charles Schwab purchased TD Ameritrade. So this move was inevitable. It was always going to take place. This just so happened to be, they're going to have it happen the same year that we made our own transition from Integrity Advisory to Inman Wealth Advisors. We are fully committed to moving forward with the Charles Schwab transition. That's where all of our clients today are moving to. I know you've been inundated with mail. I've been inundated with mail about, hey, here's setting up your online access. Here's your new account number. We've gone ahead and just blacked out the entire week after Labor Day to just be accessible to you. So if you can't get online, you can't access your accounts, just come on into the office. That entire week, we're going to be here, not Monday. The rest of the week, we'll be here in the office. Feel free to come in whenever you want to. We will be here to get you online and make sure that you have the same access that you have today. We'll also be happy to hop online, do a share screen with you. And if that's even more convenient for you, or if you're not local, just reach out to us. We'll be happy to do that. For stock market update, 2023 so far has been a great year up until the last couple of weeks. The last couple of weeks have started to get a little bit choppy, mostly in kind of those large cap names. Apple, Amazon to some degree, Microsoft certainly, NVIDIA was a high flyer that started to come back down. Some of those really are kind of like artificial intelligence related, but those big names, which make up a big portion of the S&P 500 and the NASDAQ, have started to come back down because their valuations were expensive. You know, when you take those top 5-6 names out of the S&P 500, the rest of the index does not look expensive at all. Actually, it looks pretty average. So there's reason for optimism when you think about what those valuations look like. But again, when you look at the big names, they look a little bit expensive. So we do think there could still continue to be a little bit of volatility. The other part of that equation continues to be interest rates. We've talked about this all year. Inflation, we actually had some good numbers this week when it came to inflation. Actually came in a little bit below expectation, which was positive. Housing continues to make up the biggest component of that. One of the things we really have to watch, though, with inflation here recently, and what's kind of led to some of this volatility, is the back end of the yield curve. So up until this point, the market was expecting that the Federal Reserve, they control interest rates on the front end of the yield curve. So if you remember, normally with the yield curve, it should start lower and go higher over time. If you're loaning somebody money, the longer you loan them money, the more interest they should pay you because your money's at risk for a longer period of time. Our yield curve today is inverted. So it's higher up front, and then it dips down, and then starts to kind of level out. In the last couple of weeks, we have seen that the back end of the curve has started to go up. That's not what the market expected. The market thought we would have some economic softness come through, and the Federal Reserve would have to lower the front end of the curve, and then things would normalize around a 3-4% number for a long-term interest rate number, which would be a pretty good number when you think about if companies need to go out for financing. 3-4%, that's not too expensive. That's a pretty good number for them. If instead that number ends up being 5, 6, 7%, all of a sudden that's a different equation when it comes to valuations, specifically when it comes to companies that might have a lot of debt. If they're financing that debt, instead of at 4%, it's at 7%, that means something to them and their balance sheet. So the market's starting to kind of grapple with, what if we thought about this incorrectly? What if the economy ends up being okay, and instead of the Federal Reserve having to bring interest rates down, what if the rest of the rates move up? And if that happens, then everything becomes a little bit more expensive from a financing perspective. So we'll just have to kind of see how that plays out. We're certainly watching the 10-year or the 30-year pretty closely. and looking at the difference between the treasury bonds, corporate bonds, etc. So something to keep an eye on. We've always thought there would be some volatility as we get to the back half of the year. That is continuing to kind of play out here, just a little bit for different reasons. So we'll just have to keep an eye on it as we go into the back half of the year. But from an economic perspective, numbers still continue to come in pretty good. We don't see reasons to be, too worried that we're going to have a major decline from an economic perspective. So we're keeping a close eye. If you have any questions, please feel free to reach out as always. We want to be available, so feel free to give us a call or drop us an email. Thank you.